Are you a founder of a startup or scale up and don't really understand the difference between cash and accrual accounting? Either you suspect your bookkeeper is doing cash when they should be doing accruals, you've been forced to switch from cash to accrual accounting, or you don't know. You have no idea. Well, this is exactly what I'm going to go through in today's video, is explaining the difference between cash and accrual accounting and demonstrate why accrual accounting is far superior. Hi, my name is Alicia Randall from Fast Growth Consulting, and I help founders transform their finance function to help minimize risk and maximize growth. And yes, I am going to go through an Excel spreadsheet. It is the best way to demonstrate the difference between cash and accrual accounting. So hopefully then you'll see after this illustration exactly why accrual accounting is better. So I've just created this little model that can show the difference between the two. So for ease, I have chosen to do a SaaS business, so subscription-based business. And in this example, we have 100 customers who pay a monthly fee of £10 for the same months that the revenue is received. So cash and revenue is exactly the same. And £1,000 then is received each month from these 100 customers. Then this particular SaaS business offers upfront annual payments in month one. And if customers choose this, they get a small discount. So they pay for the full amount upfront, but they get a discount so that it works out to about £9.50 or $9.50 per month. So from a cash perspective, we are going to look at the revenue, then we're going to look at cost of sales, the gross profit, the margins, some fixed cost example, and then the operating profit and margin. Now, if you don't understand a P&L properly, then feel free to have a look at our P&L explainer video, and I'll link that above and below. So in the cash example, you would receive £1,000 every single month from your customers who are paying for a monthly subscription. Now, in this scenario, I've assumed that you don't lose any clients and you don't gain any new ones, just so that you get a proper comparison and that normal commercial movement that you would expect within your business doesn't kind of distort the comparison here. And then your annual customers would pay for, the 50 customers would pay their amount upfront in month one, and then they wouldn't pay anything for the next 3 months, well, actually for the next 11 months until their annual is due at the beginning of the year again. So here you can see that the revenue is very chunky. You get quite a healthy month one, but then month 2, 3, and 4 is quite the opposite. It's like quite low and it's not overly exciting. Now, the annual revenue in this example is the annual amount that you get plus the £1,000 multiplied by 12, because you get that for 12 months. So the annual revenue in this example is 17,700. Now, the accrual one is exactly the same with the monthly revenue because they are paying for a month's revenue in the same month that you're delivering that service. And so therefore, it's exactly the same. However, it's where the annual is different. So even though you might be receiving 5,700 upfront, you actually are receiving it for the full 12 months of service. And therefore, you're only going to recognize 1/12 of that every single month. So every single month for 12 months, you will get 1,475 revenue. Now, on the surface, well, unless you go for the full 12 months, but on the first surface, the first 3 months in particular look much better in this method compared to this method. But if we say, okay, this is going to be exactly the same, then you can quite clearly see that the annual revenue will be exactly the same, whether you do cash or accrual method. It's just recognized over a different period. So then we have the cost of sales. So in this example, I'm assuming that we have to pay £2 per customer per month. However, you're in an agreement with your supplier that you have to pay for that quarterly upfront. So from a cash perspective, you pay £900 in month 1, then you pay 0 in month 2, 0 in month 3, and then you pay £900 again at the next quarter. From an accrual perspective, you are recognizing that 900 over the 3 months because it is £300 for 3 months, and then you pay again and another 300 for 3 months. So it's consistent again. Now here you can see that the gross margin, which is what I look at very closely, and so do your investors, gross margin in the cash perspective is 87%, then 100, 100, and then 10. And so when you have this, even in this simple version, you have no idea how profitable this business is. If you do it for the full 12 months, then you do, but obviously that's not the case. You can't, well, you can predict, but essentially it's very difficult to understand the profitability of the business. And if you're adding in new customers, there's customers that are churning, there's different products, it's much harder. This is a very, very simple model, and it's still difficult to see the profitability of this business or of this product. In the accrual accounting, however, you can very clearly see that it is an 80% profitable product because you're only paying 20% of the revenue out to deliver that service. So this is what I would expect gross margins to be. And when you have, a bigger business with many more different complexities, I would expect gross margin not to move more than a couple of percent. If it does, you may have some of this issue. Sometimes I've found with businesses, they may have most of revenue, accrual method, and then maybe 1 or 2 elements of cost of sales, cash accounting, and vice versa. But essentially, this is very much what your management accountant should be doing, and that is understanding the timing of when these things should be recognized. Now, similarly, let's say that you have an insurance policy and it costs you £1,500 for a full year, but you didn't organize that until month 4. So in month 1, you would have 0, 0, and then in month 4, you have to pay for the full amount. Then if you compare that to the accrual method, you would accrue for, if this policy is for month 1, 2, and 3, you would accrue for the monthly amount regardless of when the cash was paid. So again, you can see that the operating profit is quite consistent in the accrual method, but it's all over the shop in a cash. And I have seen companies, young companies, where we come in and help founders fix essentially finance function. I have seen instances where it looks like this. And even when I'm doing a due diligence for a couple of venture capitalists when they're very early stage, I've also seen this. So when you're looking at a P&L, profit and loss, that looks like this, it's really hard to understand how the business makes money and the profitability of the business in general and the business model. The balance sheet is used to help with the timing. So when you have accrual accounting, things on your balance sheet such as accruals, prepayment, deferred revenue would all be used to manage the timing. So the difference between these two is this one, the balance sheet gets used heavily, whereas here everything just goes in and out from your bank account. So this is where your management accountant really comes into play. This, of course, is just showing really your cash flow. So you do have a cash flow statement, so you should be receiving a P&L, a balance sheet, and a cash flow statement on a monthly basis. Again, I have cash flow statements explained, and that is what a cash flow statement is for, to show your inflows and outflows. It is not what a P&L is for. A P&L is to show the profitability of a product and the business in its entirety. So this is why accrual accounting is far superior. You can really understand the business much better, whereas cash accounting, you really don't understand whether the business is profitable or not, especially when you're looking at it from a month-by-month basis. Anyway, I hope that is useful, and it really kind of shows what management accountants can do for you. If you have a management accountant working within your business that you want to grow and develop, we do offer online courses that might be useful for them, or you can send them to this video. But if you're a founder that wants to improve your current finance function, then please do hit subscribe, because this is exactly what I talk about, and this should be quite useful for you. And I'll see you in the next video. Cheers.